Hi, this is Steve Roy with today's Lone Star Lending Starbits rate update. If you needed a recipe for a rate rally, just take a look at recent financial headlines. Friday, the president announced a tariff on an additional $300 billion worth of Chinese imports, and the investor herd started making flight to safety trades, buying up U.S. bonds. When the demand for bonds is high, rates are low because the bond issuers don't have to offer as much interest to entice bond purchases. Almost lost in the stampede was last Wednesday's Fed rate cut and the good jobs report on Friday. Without the stampede, I'd hazard that we'd be stuck in the summer doldrums again, wondering when rates would move higher or lower. Fed head Powell hemmed and hawed when asked if the Fed would cut rates again this year, and the jobs report was strong enough to suggest a continuation of moderate economic growth. Neither provided a clear signal to investors. But investors got their signal Friday and believe it was reinforced by weak global economic data today. On top of that, China devalued its currency overnight to levels not seen since the depths of the Great Recession. That matters because it suggests a number of rate-friendly effects. It suggests the trade war isn't going to end soon. By devaluing its currency, China hopes to keep its goods competitive, despite the tariffs. Lower import prices lead to lower inflation, the mortal enemy of interest rates. It increases the chances of a recession, and that increases the chances the Fed will have to lower short-term rates even further. As usually happens when Treasury rates fall so quickly, only a fraction of the gain is filtered through to mortgage rates. However, if Treasury rates remain in this new lower range, mortgage rates eventually will catch up. That's Starbits for today. Please comment below and follow us daily on our Texas Lone Star Lending website.